Is the Chinese yuan about to replace the US dollar? Short answer, not yet, but it is getting closer than most people think. And by the end of this video, you are going to know exactly what is happening, why it matters for your wallet, and the 5 exact moves you can make right now to protect your money and actually come out ahead. No textbook stuff, no boring economics lecture, just the real situation and the real plays. Let's go. So here's the thing nobody's really talking about at your dinner table, but every single major bank on Wall Street is sweating about behind closed doors. The US dollar, the one paying your rent and filling your gas tank, is quietly losing power, and the data is not even subtle anymore. So today, I'm giving you the facts fast, and way more importantly, exactly what to do about it. But real quick, if you want more videos that actually tell you what to do with your money, hit that like button and subscribe. Free to you, huge for me. Cool, let's get into it. So here's the deal. After World War II, the United States basically became the most powerful country on the planet. And because of that, the whole world agreed to use the US dollar as the main currency for international trade. So if Brazil wanted to buy oil from Saudi Arabia, they didn't pay in Brazilian reals or Saudi reals. They paid in US dollars. If Japan wanted to trade with Germany, they settled in US dollars. The whole world needed dollars to do business. And that gave the US a serious cheat code. Borrow cheap, print more whenever, run up debt, no problem, because the rest of the world kept buying dollars anyway. It was like being the only store in town. You can charge whatever you want because people have no other choice. But that deal is quietly cracking. Here's what changed. A group of countries called BRICS, that's Brazil, Russia, India, China, South Africa, and a growing list of friends, together now make up about 45% of the entire world economy, while the US and its Western allies represent about 30%. Read that again. The team that built all the rules now controls less of the global economy than a team that basically didn't exist 30 years ago. That's a huge shift, and the dollar is feeling it hard. In 2016, the dollar made up about 65% of all the currency reserves held by central banks around the world. Today, around 57%, and the drop is speeding up. Why? One moment flipped everything. In 2022, when Russia invaded Ukraine, the US froze Russia's dollar reserves, just like that, locked. And every country that's not best friends with America watched that happen and basically said, okay, we need a backup plan, yesterday. So they started building one. Countries are now trading directly in their own currencies, cutting the dollar out. China and India doing deals in yuan and rupees. Brazil and China trading without touching dollars at all. Central banks are buying gold at the fastest rate in over 50 years. Why gold? Because nobody can freeze it. Nobody can sanction it. It's not anybody's currency. China launched their own payment system called CIPS, can move money around without going through US-controlled networks. There's also mBridge, a digital payment system being tested by China, Hong Kong, UAE, Saudi Arabia, and Thailand that lets countries settle payments without ever touching the dollar. And there's a proposed new currency called the unit, backed 40% by gold and 60% by BRICS currencies, literally designed to replace the dollar in global trade. Now listen, the dollar is not going to zero next Tuesday. Chill. But you don't need to replace the dollar to weaken it. You just need enough countries to use it a little less. And that's exactly what's happening right now. Now, is the Chinese yuan replacing the dollar tomorrow? No. China has strict capital controls. You cannot freely move money in and out of China. That makes the yuan uncomfortable as a global reserve currency. And the dollar still has serious advantages. It's used in 89% of all foreign exchange transactions. SWIFT data shows the dollar at 49% of all global payments, and even the BRICS alternative payment systems still largely route through the dollar infrastructure. In fact, China's own payments still rely on SWIFT messaging for a significant portion of their transactions. Not to mention the United States is still the world leader when it comes to artificial intelligence, semiconductors, and biotech. This means short-term, we're not seeing a dollar collapse. We're just seeing a dollar dilution, where the United States is going from being the only global superpower to becoming one of several powerful players in a bigger world. And that transition is likely going to take decades to fully play out, but the early money is already starting to get ahead of it today. So what does this actually mean for your money? This is where you need to pay attention. Right now, the average American investor has about 80% of their money in US stocks like the S&P 500, and for the last 50 years, that was honestly the perfect move. America was the fastest growing, most profitable economy on Earth. You couldn't lose. But here's what the biggest banks in the world are now saying about the next 10 years. And trust me, this is not what most people want to hear. Vanguard is projecting U.S. stocks to return just 3.9 to 5.9% per year over the next decade. That's weak compared to what investors have been used to. Meanwhile, international markets are expected to return more, around 4.9 to 6.9% annually. JP Morgan is projecting emerging markets to grow at around 7% a year. Fidelity is calling over 8% annually for emerging markets over the next 20 years. Goldman Sachs believes China overtakes the US as the world's biggest economy by 2035. India is expected to become a $10 trillion economy by 2036, with 1.5 billion people who are younger, growing faster, and more tech-savvy than almost anywhere else. And by 2050, emerging markets are expected to make up nearly half of the global stock market, up from just 27% today. So every single major bank independently looked at the data and came to the same conclusion. The rest of the world is going to grow faster than America over the next few decades. Not because America is done, America is still a beast, but because the rest of the world is catching up fast and starting from way lower. And here's something wild that most S&P 500 investors don't realize. The top 10 companies in the S&P 500 right now make up 40% of the whole thing. So you think you're diversified across 500 companies, but really almost half your money is riding on just 10. That's a scary amount of risk nobody talks about. Plus, if the dollar keeps weakening, then foreign stocks that earn money in their own local currencies will actually return more to American investors once you convert those earnings back into dollars. So a weakening dollar is actually a tailwind for international investing. Wild, but true. Okay, enough of the problem. Here are the 5 exact moves to make right now. Simple, clear. You could start this weekend. Move 1. Stop putting 100% of your investments in the US. This doesn't mean sell everything, it just means stop sending every single new dollar you invest into only US stocks. Aim for around 20 to 30% of your portfolio in international. Start there. Even that small shift gets you meaningful protection and upside from what's coming. Move 2. Buy a total international index fund. This is the single easiest, most powerful move in this whole video. You don't need to research individual stocks in India or Brazil or Germany. Just buy one fund. VXUS from Vanguard gives you exposure to over 8,000 companies across every developed and emerging market outside the US in one single purchase. One click, done. You are now invested in the fastest growing parts of the world economy without doing any extra work. Move 3. Add some gold. Now, I know gold sounds like something your grandpa talks about, but when every single major central bank on Earth is buying gold at record pace specifically because the government can't print more of it, you pay attention. You don't need a lot. Even 5 to 10% of your portfolio in gold makes sense right now. The easiest way to do it is through ETFs like GLD or IAU. They trade just like regular stocks on your brokerage app. Super simple. Move 4. Get some commodities exposure. Oil, copper, metals, food, agriculture. As billions of people in emerging markets move into the middle class over the next 20 years, they're going to need all of this stuff in massive quantities. A simple, broad commodities ETF like DBC gives you broad exposure across all these categories in one fund. Even 5% of your portfolio here gives you a solid inflation and currency hedge. Move 5. Keep the US as your core. I'm not telling you America is over. Keep the biggest chunk of your portfolio in US stocks. Vanguard still projects 4 to 6% annually for US stocks, which is still solid long-term growth. America still has the best tech, the best innovation ecosystem, the deepest financial markets. None of that is going anywhere overnight. The only thing changing is that the US should now be your core, not your only bet. So, here's the whole strategy in one clean sentence. Keep most of your money in the US, add 20 to 30% international, sprinkle in some gold and commodities, and then just leave it alone and let time and compounding do their thing over the next decade. That's it. That's the entire playbook. Look, this isn't a doom and gloom situation. The dollar is not collapsing. America is not over. What's happening is a slow but real shift from America being the only superpower to America being one of several powerful players in a bigger world. And that transition is likely going to take decades to fully play out. But the smart money is already moving now. The big banks are already adjusting their portfolios now, and the people who win the next decade aren't going to be the ones who perfectly timed every move. They're going to be the ones who saw this coming, made a few simple adjustments, and then just let time and compounding handle the rest. If America stays on top, great. Everything carries on as usual. But if things do shift and all the data says they will, then at least you're not caught flat-footed. You're positioned. And positioning early is literally how generational wealth gets built. Alright guys, that's a wrap for today. If this video opened your eyes a little bit, please smash that like button and subscribe. It genuinely helps more than you know. See you in the next one.